The Bank of England just dropped a bombshell, warning that a major financial crash could be on the horizon. Are we on the brink of economic chaos, or is this just another false alarm? In the next few minutes, we're breaking down exactly what's happening, what it means for your money, and how you can protect yourself before it's too late. Welcome to UK Economic Report, your go-to channel for the latest updates on the UK economy. From inflation and interest rates to housing trends and government policies, we break down the numbers so you can understand how they impact your finances. The Bank of England has a long history of monitoring the financial system closely. Their job is to keep the economy stable, control inflation, and prevent shocks that could spiral into a full-blown crisis. So when they issue warnings, it's not something to take lightly. According to recent reports, their concern centers around a combination of rising interest rates, inflation pressures, and vulnerabilities in the housing and banking sectors. Each of these factors on its own could be manageable, but together, they create a potentially dangerous cocktail for the UK economy. Interest rates have been climbing steadily over the past year. The Bank of England has been raising rates to combat inflation, which is at levels not seen in decades. On the surface, higher interest rates are supposed to slow down spending, reduce inflation, and stabilize the economy. But the downside is that borrowing becomes more expensive. Mortgages, loans, and even credit card debts are impacted. Millions of households in the UK are feeling the squeeze, and economists warn that this could lead to increased defaults if the trend continues. Inflation itself is another major concern. Prices for essentials like food, energy, and housing have been skyrocketing. While the Bank of England aims to keep inflation under control, global factors such as energy price fluctuations, supply chain disruptions, and geopolitical tensions make it incredibly difficult to maintain stability. When people spend more just to cover basic needs, there's less money circulating for other parts of the economy. Businesses feel the pinch. Growth slows, and if unchecked, this can feed into a financial crisis. Another critical area that the Bank of England is watching closely is the housing market. Property prices in the UK have been on an unprecedented rise over the last decade, fueled in part by low interest rates and high demand. But with rates climbing, many homeowners could struggle to meet mortgage payments. A sharp decline in house prices could trigger a wave of defaults, which in turn would affect banks and the wider financial system. History has shown us that housing market collapses can be a catalyst for wider economic crises, as we saw in 2008. Speaking of banks, the financial sector itself is not immune. Banks hold a mix of loans, mortgages, and investments, all of which can be impacted by economic shocks. If defaults rise or asset values fall, banks could face significant losses. The Bank of England monitors these risks closely through stress tests and regulatory oversight. Their recent warnings suggest that some banks may be more exposed than previously thought, especially smaller institutions that don't have the same level of resilience as major players. But let us step back and ask the big question. Does a warning from the Bank of England mean a crash is inevitable? Not necessarily. The bank's primary role is to warn, guide, and take preventative measures. By signaling potential risks early, they hope to encourage governments, businesses, and individuals to prepare and take action. It's a proactive approach rather than a declaration of doom. Markets often react sharply to such warnings, which can create volatility, but that doesn't always lead to a full-scale financial collapse. For individuals, the key takeaway is preparation. Understanding your financial situation and making strategic adjustments can make a significant difference. For instance, reviewing debt, refinancing mortgages, or building emergency savings could help mitigate the impact if the economy faces a downturn. Diversifying investments and keeping an eye on economic indicators can also provide some protection. Knowledge and preparation are your best defense in times of uncertainty. For businesses, the Bank of England's warnings serve as a reminder to manage risk carefully. Companies with high debt exposure or reliance on volatile markets may need to reevaluate strategies. Supply chain disruptions, rising input costs, and shifts in consumer demand could all become more pronounced if economic pressures intensify. Being proactive rather than reactive can help businesses weather potential storms and even find opportunities in challenging times. It's also worth considering the role of government policy in all of this. The UK government works alongside the Bank of England to implement measures that stabilize the economy. Fiscal policy, regulatory changes, and targeted support programs can all influence whether warnings translate into actual crises. Recent statements from policymakers emphasize resilience and cautious optimism, suggesting that while challenges are real, steps are being taken to mitigate worst-case scenarios. Global factors also play a role in shaping the risk landscape. The UK is part of an interconnected world economy, and shocks in other regions can quickly affect domestic markets. Trade tensions, currency fluctuations, and international crises can amplify existing pressures. The Bank of England monitors these external risks closely, which is part of why their warnings often capture widespread attention. They're considering not just domestic factors, but global ones too. So what should viewers take away from all this? First, pay attention to credible sources and avoid panic. Warnings are meant to inform, not terrify. Second, take practical steps to strengthen your financial position. Whether it's budgeting, saving, or reviewing investments, small actions now can prevent larger problems later. Third, stay informed about policy changes, interest rates, and market trends, as these will influence how the situation unfolds. While it's impossible to predict the future with certainty, one thing is clear: vigilance is key. The Bank of England's warning is a call to awareness, a reminder that the economy is fragile and that we all have a role in managing risk. History has taught us that financial crises can be sudden and severe, but preparation, prudence, and informed decision-making can significantly reduce personal and collective impact. In conclusion, the Bank of England's alarm should not be dismissed as mere speculation. The combination of rising interest rates, inflation pressures, housing vulnerabilities, and banking risks is real. However, it's also a reminder that forewarned is forearmed. By understanding the risks, taking proactive steps, and keeping an eye on evolving economic conditions, individuals and businesses can navigate uncertainty more effectively. A financial crash is not guaranteed, but awareness and preparation are your best defense against potential economic turbulence. Thanks for watching UK Economic Report. Don't you forget to subscribe and hit the bell icon to stay updated on the latest UK economic news, expert analysis, and financial insights that matter to you.